Hello and welcome to the Beta Kit Podcast. My name is Katie Lohr. I'm the producer for the show. And the reason why I am taking over hosting duties as usual is because we have another exciting AMA for you. Of course, I am joined by Douglas Soltis and Rob Kennedy. Both of you, thank you so much for joining me on your show.
Just happy to be invited.
And today we have a special guest who is joining us for the AMA, RBCx's Director of Venture Capital, Anthony Mouchantaf, aka Tony Dagger.
Thanks for having me. Yeah, I wasn't sure if you'd have me back.
Well,
the contrary.
When the DMs start going emergency pod conversation, it's got to happen, right?
So we are super excited to have you here, Tony, because we have a lot of questions that were submitted that we would love to hear your opinions on. So, Douglas, should I just jump into it?
Yeah, let's do it. Let's hit it with the one that this is the one that sounded the AMA emergency pod alarm. So we might as well just dig into it right away.
Okay, the big one. What's the impact on the Canadian VC now that VCCI, aka Vicky, venture capital capitalist? Whoa! Why can't I not say this?
It's acronym for a reason.
I've never actually said it. I actually put that in the notes because I've never said it out loud.
Okay, I'm going to ask the question for reals this time.
Great.
Take 7.
What is the impact on Canadian VC now that Vicky, the Venture Capital Catalyst Initiative, is apparently no more?
I'll take that.
So listen, I think it's net probably a bad thing.
Do you want to even just set it up before we get to the bad thing? Like, part of the reason why you're here is because you wrote a 4-part series talking about the state of Canadian venture and might have hypothesized, man, it really seems like Canadian venture is pretty dependent upon government funding. What would ever happen if that government funding were to no longer be there? Wink. And then this week it is not announced because the government doesn't announce not funding programs, and we've got some maybe additional reporting we can talk about, but the head of the CVCA, Kim Furlong, is saying that the CVCA will not ask for future funding rounds of VCCI. So why is that net bad?
So it's net bad. And I'll start by saying that when I wrote that 4-part series, I think it was late last year or early this year, I didn't have advance warning that this was what was going to happen. My hope, maybe not my expectation, but my genuine hope was that Vicky would get permanently institutionalized to some extent, that there would be some entrenching of the program and an ongoing expectation that every 3, 4, 5 years, whatever the case may be, there would be a similar, call it envelope, that would be available to fund of funds managers in Canada. What I had said at the time was that, yes, we're disproportionately dependent on government money, but maybe paradoxically, we need more of it, but proportionately, we need less of it. So essentially, the prescription there was, let's put more government capital to work, but let's also figure out ways to put more private capital to work and get more overall capital into the ecosystem.
Somehow more and or less heroin at the same time.
Basically. So the reason it's appropriate, and I think any sort of sensible observer would say this, is, venture capital as an asset class is fundamentally different from basically all other asset classes because venture is intrinsically, to some extent, impact investing, okay? Venture capital is not about figuring out the distribution of the slices of pie. It's about pie creation, right? Obviously. So successful companies create jobs. They create new technologies. They can change the trajectory of a society, of an economy. Just today, actually, the news dropped that Xanadu raised another $100 million and is now, I think, has a private market cap above $1 billion. So Xanadu
looking to raise. I don't know if that round's closed yet. Hoping to raise that.
Well, let's assume they're successful at it. That's a business that's working on creating a quantum computer. They are hiring, last I was in air quotes involved with the company back at Omer's Ventures, they had, I guess, hundreds probably of PhDs from around the world here in Toronto working on this project. They would change the trajectory of this country's economy if they're successful. And I can tell you that somewhere on their cap table, there is government money. And that being absent, who knows, right? Like maybe Xanadu's a bad example, just given how extraordinary that business is. But this kind of fact pattern repeats itself across the tech ecosystem. So if you remove government capital entirely, you risk some funds going belly up, frankly. You risk some funds significantly downsizing, and you risk kind of those ramifications sort of trickling down to startups and founders and all that kind of stuff. What a lot of folks forget is that a lot of amazing tech ecosystems around the world, notably the US, was and is for a long time, I wouldn't say dependent on government support, but intimately tethered to it. DARPA and the US military, like these are programs that supported non-economically viable new technologies for decades in many cases and brought them to market. And so I think it's entirely appropriate recognizing that a lot of the value creation from startups accrues to society as a whole. It accrues to everyone. It's entirely appropriate for the federal government to take an active position in that. And the critical misnomer here is it's not a government expense, right? It's not a subsidy. It's not aid. It's investment, right? It's an investment program. Essentially what it means is that all Canadian taxpayers become shareholders to some extent in these companies. And what we know for a fact is that these programs have driven S&P beating returns for taxpayers, right? So taxpayers are coming ahead on a purely financial returns basis. And they've played a critical role in establishing, growing, and scaling probably some generational businesses. And if we're going to think about future-proofing the country, this is without a doubt the most proximate, effective way of doing it. So, and this is, I'm sure Kim and the CVCA pushed, right, to do what we're talking about. I'm sure they pushed to get this thing institutionalized. But for whatever reason, I think the optics around it, maybe government felt that the general sentiment was, you shouldn't be investing in private companies. You shouldn't be giving money to money managers to invest. Whatever the case may be, net, this isn't a good policy. And it could be bad, especially now.
Before we get to maybe the optics and the decision around it, can you explain for our listeners who might not be familiar with VICI or VCCI or its predecessor, VCAP, how this government commitment, this government program would end up putting money in a Xanadu or any other company? What's the process through which this government program or commitment ends up as capital in generational businesses?
So there's a multi-step process to get that money from government into startups. So everyone, generally speaking, is familiar with startups and venture capital firms. But if you were to, go deeper down the iceberg, I don't know if that's even a saying, but if you were to look at it kind of like more
it is now Tony Dagger.
Deeply, kind of what's happening behind the scenes is, so these venture capital funds, they don't just manifest money and invest it. They themselves are also entrepreneurs in their own way, and they're constantly fundraising. And they're going to money managers, typically big asset managers and real true capital allocators. And what I mean by capital allocators is not that they're just investing in one asset class, but they're deciding, broadly speaking, to invest in private equity and venture and fixed income and real estate. And venture is one sliver, typically, of what they do. So venture capital funds are always fundraising for new commitments for them to invest in startups. And so the folks that they're fundraising from, one class of those investors are called fund of funds, right? And the people who run them are called fund of funds managers. And what these individuals do is they invest in venture capital funds. They don't invest in startups. I'm simplifying, right? They do in some cases, and there's co-invest and all that kind of stuff. But broadly speaking, for our purposes, they are investors in venture capital funds. They back the VCs.
Indirect investment.
Indirect investing, fund investing, whatever the vernacular you choose. What VICI does is it selects a handful of really good fund of funds managers in Canada, typically with a strong track record, or individuals who've been doing this for a long time. And they'll say, here's an amount of money. Here's $100 million, let's say. If you can go raise against that 100 million, another 200 million or another 300 million from private investors, we'll anchor your fund. So you'll have a $400 million fund that you can then go invest in venture capital funds. And above and beyond just anchoring it, they sometimes mess with what's called the waterfall or the preferred return, right? So basically, what you need to understand is that if you're participating in a VICI fund historically, private investors would tend to get their money out before the federal government did. So there's some additional layer of risk mitigation if you're a private sector investor, and there's another layer of kind of sweetening the proposition for
Which
you.
changed previously between VCAP, which was the predecessor fund under the Conservative government, to the Liberals version of the program, where the government was in the waterfall changed a little bit.
Yeah, and honestly, like, I don't actually think that the waterfall, I think it's not much ado about nothing, but it's not that important to the calculus of private investors. I think the bigger thing that the federal government does is that it anchors the fund, right? It's providing like a big slug of cash, and it's picking up the pen, and it's participating in setting up the fund, negotiating the legal docs, participating in the management of the fund, all that kind of stuff. And it manages through BDC. It manages the program through BDC.
Okay, let's pause there, because you're talking about who decides who gets this money. You mentioned BDC. We should maybe talk about the process of deciding who gets it. But if you can go raise $300 million, why do you need $100 million from the government to make a $400 million fund? What does it mean to anchor a fund? How does that lead to kind of fund creation?
Yeah, so let's say you're starting a fund, right? And I want to invest in your fund. And I'm not a particularly wealthy guy, and I want to invest $25,000 into your fund. I like startups. I like venture capital. I think it's cool. I want to have some exposure to innovative stuff, but I'm not an expert, right? Like, I don't know how these things work. I've never negotiated a limited partnership agreement. I don't sit on LPAC committees to govern these funds. That's not who I am, right? I'm a family office. I'm a small investor, and I'm interested in tossing some money in. When the government comes in, and when you have one big check writer who's able to take a big risk and take a big chunk of a fund, that individual basically picks up the chopsticks for everybody, right? Or they pick up the pen, so to speak, and they will negotiate that limited partnership agreement on behalf of everyone. So they'll determine the terms under which the fund operates, what the fund manager can and cannot do. And you really want professionals with significant skin in the game doing that piece, right? So by bringing in an anchor, you mature a fund essentially. You put meat on the bone, and you make it more palatable for smaller investors, more passive investors, to get involved in that fund, right? And so suddenly, with the government anchoring this thing, and of course, if there's a waterfall component, if there's a different kind of economics there, then you're much more comfortable saying, you know what? Yeah, like, they've pre-vetted this fund. They've gone through the kind of diligence process. This is a good fund manager. T's have been crossed, the I's have been dotted. I'm going to write a $25,000 check and take an index on Canadian tech. It lubricates the whole process. It facilitates it significantly.
It's almost like if you're an entrepreneur, you're waiting for that first check in, and the person who writes the first check in your business has to do all the due diligence, has to do all the things, and it signals that it's an investable thing, and maybe you can be lazy and come along with it. I mean, no, it's not a perfect metaphor, but it's a similar kind of idea, isn't it?
It's an almost perfect metaphor. Yeah, it's exactly that. So for founders and entrepreneurs who've raised capital, it's like finding a lead, right? Like, if you raise a $30 million round, it's probably one investor who's taking 10 to 15 million of it. They're taking the board seat, they're negotiating the terms, they're valuing the business. Everyone else kind of follows on. You take out the lead and the round doesn't come together. I think it's a perfect analogy.
So what capacity does the Canadian VC ecosystem have following this last final version of Vicky to continue to facilitate this? And which funds does this money normally go to? Because I think if you were to look at what Kim Furlong, head of the CVCA, who represents Canadian Venture Capital Association, like basically the trade organization for Canadian venture, there's a certain group of orgs that lead that as well, that set the terms and that participate in this stuff. This is going to be the final run of this. This capital will be deployed hopefully a little bit quicker than the last Vicky. That means it'll be invested over the next 2 or so years into Canadian startups. What happens after? When you were talking with us earlier at the beginning of this year, kind of setting the agenda, we were talking about all that turbulence, that friction, transition from boom times to uh-oh times. Doesn't this seem to be like a really weird time to, and again, the government hasn't said that they're not committing. The CVCA is saying that they're not asking anymore for an additional commitment following this. And I'm going to tread carefully here and what I might have heard, but just what I'm willing to report. What's the implications of pulling out this commitment right at the moment where everyone's like, every company's getting marked down, every fund's getting marked down, people are getting laid off, companies are going bankrupt, just starting to again.
It's bad. It's bad. It's okay. That's the bad news is that extracting this capital from the ecosystem is gonna have significant impacts any way you slice it. Whether it's today, whether it's in 3 years from now, we're not going to be at a point where you can remove that capital and have things continue on unabated. I think some funds discontinue. They oversee the remainder of their raised capital, they deploy it, they manage those investments, but they don't raise subsequent funds. Or they downsize significantly. And if they downsize significantly, then they need to rethink their strategy. I think the market could migrate to more kind of seed and Series A deals. I think you see a dearth of growth. There's a whole bunch of kind of downstream impacts in 3 years. That's the bad news. The good news, though, is at least there's this next round coming into being, hopefully before the end of the calendar year, maybe early next calendar year. And that has a really critical counter-cyclical role to play in this economy, because I'm not going to get too technical on this because it's just not interesting. But what you need to understand, and when I wrote the All That Glitters Is Not Gold, I was a little bit ahead of everything that's happening, but I was actually, I got accused of being a little bearish, and people kind of get texts and calls being like, oh, you're such a, you're a Debbie Downer. I was probably too optimistic about it. I think
welcome
we were
to
all
the pod,
wrong.
sir. You are now a true member of the Beta Kid podcast.
I think we were all wrong about the extent of the inflationary problem. And I think we were all wrong about where the bottom was going to be on public stocks and on private market valuations. And I actually don't know if the worst is over now. My view is that the market's probably priced in 50 basis points in June from the central bank, but quantitative tightening hasn't even started yet. And again, I'm careful. I don't want to get too technical. Just what your listeners need to understand is that the central bank basically pumped out hundreds of billions of dollars out of thin air, and that created an asset bubble. And they've just now started to rectify that, right? They overcorrected on COVID. They put too much liquidity in the market, but that liquidity is still out there, and the market's only pricing in some portion of that quantitative tightening. So I think over the next 2-3 years, things might get really, really bad, particularly as companies that raised mega rounds in 2021 start to run out of runway and need to go back to market with maybe 50% write-downs if they're lucky, if they're not growing fast enough, if they're not kind of level setting the business. So we're going into really weird territory right now. And this Vicky money is absolutely critical to help the ecosystem kind of withstand that, and to make sure there's a certain degree of continuity in VC, in the fund of funds ecosystem, and that there's some basic level of quasi-permanent capital that's not going to run for the hills over the next 18 to 24 months.
Yeah, I think the weird territory we're getting into are our second and third questions that were submitted to us for this AMA. But Kay, before we go to that, can I just ask just one more question of Anthony on this topic? But I'm just wondering, from the perspective of the VC ecosystem, again, this isn't the government announcing that they're no longer continuing this program. In fact, the Globe and Mail's reporting with an interview with Kim Furlong of CVCA came out the day that the Minister Ng announced that applications were open for the next run of Vicky. What signal does it send to the Canadian VC ecosystem that the CEO of the organizations that's supposed to represent their interests says that they are no longer going to advocate or ask for this type of funding? Speaking of anchors, speaking of confidence building and liquidity, what is it mean for, what's the downstream implications of the head of the organization representing Canadian VCs saying that they're not going to try and keep this going?
Again, I think that what I read into it, what I would surmise from that is that rightly or wrongly, my inference would be that that's coming from the government, not coming from the CVCA, right? So Kim and the CVCA aren't going to go to the government and say, we don't need any more Vicky money. That's not their job, right? They're out there lobbying and advocating for the industry, and they do a good job at it. RBC is a member of the CVCA, and by and large, I think the VC community has full confidence in kind of what Kim and the CVCA have been doing. What I infer from this is probably that there was some compromise reached behind closed doors, wherein the government had a certain degree of reticence about putting hundreds of millions of dollars to work in venture capital and the optics around that. And I think probably they compromised on, okay, let's do this one more round. We need to do this one more round given where the economy is today and where things are headed. But let's kick the can for 2025 or 2026 or whenever the next round of Vicky would have been teed up. Do things change between now and then? Absolutely they could. But in the interim, I don't think it's good signaling, and I think it's probably not great foresight on the part of the government. Like what they should have done is probably double Vicky. Like that's the thing, is like, this is like 450 million is table stakes for what we're talking about here. Like, how many billions of dollars does the government blow on completely random,
but the
useless
optics
stuff?
though, like, isn't the problem like minority government costs are going up? Are they not solving for they're thinking for the proximate, not for the long term? It's like, let's get us out of inflation, gas prices, and the optics of writing $800 billion to people to play with money, which I understand that that's not the case, but the optics could be a bit wacky. Is this just a political exercise then?
Yeah, it's totally optics, right?
Yeah.
There's no
in a few years there might be an election.
Yeah, but there's no, like, listen, I think a competent, benevolent dictator absolutely would put their thumb on the scale and be like, absolutely, we're going to double down because this is one of the best programs we have. I think it's absolutely optics, but I think as with most things, it's just, there's an element, like I always hear this stuff about, public works, right? Like infrastructure investments, right? Or, investing in higher education or investing in healthcare or whatever the case may be. Whereas this is typically framed as, this is aid. In fact, it was in the title of the Globe article. It's aid for the venture capital. The CVCA is no longer going to ask for aid from the government. It's not aid. It's not subsidies. It's not expenses. It's investments. The difference is that some people stand to make some money off it. Fair, right? And those are money managers, and the optics around it are poor. But what people need to remember is that these are highly, highly experienced money managers who've been around forever, who've driven meaningful returns for the taxpayers. At the end of the day, it is an investment. And if some folks standing to make some money on this is the cost of future-proofing our country and investing in our innovation private sector, then I think that's a price that we should be willing to pay.
So one last question before we go on, and this might be a good segue to the next set of questions. We're talking about signaling within Canada with investors in Canada. I mean, the whole world is going through some form of downturn, but does this send negative signals to other investors outside of Canada who are looking at Canadian companies, or is this neutral or positive for them?
My sense is it's neutral. I think the biggest investment community, in air quotes, if you will, outside of Canada that's immediately relevant to Canada is the US one. And I doubt any US investor has ever heard of Vicky or particularly cares. I think if I'm a US investor, I just think, potential bargains down the line, right? I think if the VC ecosystem
isn't stopping the foreign direct investment in any way, like they're cool with it.
I'm careful here. There's a whole other threat, like the whole US thing and the foreign thing is Canadians also, like, Canadians need to decide, right? Like, Canadians need to pick their poison here to some extent, right? It's either we're going to be very bold about this and we're going to invest in our own economy and our own innovation economy, or we have to recognize that we're hitched to the American horse and we need to take steps to further integrate our two economies, right? We need to facilitate the free flow of capital north and south of the border. We need to facilitate the free flow of labor north and south of the border. There's every province has a securities regulator and the US has a federal one. Why don't we have a North American regulator? Why don't we have a single market in North America? Why do Canadians need visas to go work in the US and vice versa? You
Be careful with that. The Fifth Circuit Court just said that the SEC can't actually regulate anything. So there are poisons to pick on either side. But I'll just say, Rob said something. He said the S word. He said signaling. And I just want to note here that the federal government actually hasn't signaled anything yet. The signaling has come direct from the CVCA in a strategically timed piece coinciding with their quarterly VC results, but also in advance of a CVC event gathering that will be taking place probably by the time this episode drops. I will say that if you talked to people, certain people at BDC, they might tell you that they don't think this program's done.
I hope you're right. The other thing I will say is what's funny about this whole conversation, and this is part and parcel with the need to institutionalize Vicky, is that we talk about the government as this kind of, multi-decade monolith, right? And the reality is you could have a conservative government in 2024, and who knows what happens in that case? Or you could have a conservative NDP government, or, maybe Quebec breaks off. Who the hell knows? Like this is partially the problem. And this was the point I made in that All That Glitters piece, is that it's fundamentally transient. It fundamentally depends on the mood in Ottawa at a particular time, versus taking steps to take this off the metaphorical balance sheet of the government and just say, this is a worthwhile thing. This is bipartisan or tripartisan, whatever it is. And this is just something that we're going to do because it makes a whole lot of sense for the country and for everyone involved in it. So that's ultimately where I would hope Vicky would go.
That article also predicted monkeypox, which was pretty impressive.
Yeah, that stuff freaks me out. I'm surprised not more people picked up on it.
I had to read the left column, the first letter of each paragraph.
Yeah, the black swan of 2022, monkeypox. This was 6 months ago, people.
No.
It'll be gone by the time this episode airs.
Okay, let's move on to our next question, which, no pun intended, maybe more bubble bursting, but let's just run with it. What happens with the bubble bursting with so many #CDN tech unicorns? Are valuations going to be treated with greater scrutiny now? And if so, what does that mean for tech sector employees?
This is the other side of the coin. We talked about those poor, sad VCs who have been spending the last 2 years throwing money around like sultans, not even counting it, and are suddenly going to their portfolio investments and their deal flow and saying, "Oh man, fun times are over, guys."
You got a cigarette?
So let's yes. Tony Dagger has pulled out the cigarette for the entrepreneurs now.
Okay, I have to note the huge sigh that just was expressed through Tony's entire being.
Tony, talk to the entrepreneurs.
There's a lot to unpack. So in no particular order, there is a class of companies in Canada, companies that are unicorns, some that are soonicorns, that are going to be totally fine, completely fine, right? It's just a literal kind of pothole. They're going to grow into their valuations in the next 18, 24, 36 months. They're going to be completely fine. These are companies with differentiated products, product market fit, amazing leadership teams, fast growth, high margin, just amazing fundamental businesses. And that's what's, I think, different right now as you look at the kind of macro environment, is that this isn't like .com-esque, right? Like there are a lot of amazing businesses that have been kind of destabilized, let's say, by central bank action fundamentally, but they're going to be completely fine. So if you're one of those entrepreneurs or you work at one of those companies, you know who you are, and, kudos to you. I think there's another class of companies that are liable to go completely belly up or may take like very significant haircuts. And these are companies that are built on just poor fundamentals. These are kind of
No. Okay, I'm gonna challenge you right now because you're gonna go through the whole. But I'm saying, are they built on poor fundamentals, or are they built on the poor fundamentals that have been created in the last 2 years because VCs have been going in at like 1,500 times ARR to get into deals? Or last week we wrote about a company that received some investment to build a search engine for the metaverse, and neither of those things exist yet. So is it poor fundamentals or reacting to the fundamentals that have been happening for the last 18 months / you're talking about these downstream 2 to 3 years from now, because of the timing of when they took money, they're just going to hit that window when things are going to get bad after this Vicky money?
No, it's poor fundamentals in many instances. It's poor fundament. It's look, you're right. Like again, there are businesses that are grossly overvalued, but many of those businesses will be fine because they'll grow into the valuations, right? Some of them won't take a down round. Some of them may take a down round, but they'll be okay. They'll get to a good place. Where it gets really gnarly is there are businesses with atrocious fundamentals. And when I talk about poor fundamentals, like these are relatively slow growth businesses, no proven kind of ability to get to even barely positive gross margins, high customer acquisition cost, high churn that got funded to the tune of hundreds of millions of dollars. And those companies are going to be in a really difficult spot, and employees of those companies are going to be in an exceptionally difficult position because the value of their equity and the value of their stock options has been, I'm not going to say deliberately, but has been significantly distorted such that it's probably fair for them to assume that the value of those shares are zero. It's kind of an abstract conversation, right? Because I'm not naming companies. I'm not.
Yeah, is that a big Canadian? Like this is a Canadian tech question. Is that a big Canadian tech? This feels more Silicon Valley style. Not to say that there are no Canadian tech companies.
Well, let's anchor. Anthony, are you seeing more layoffs happening in U.S. tech companies or Canadian tech companies right now?
I'm seeing it in both. And most companies are thinking about it in a variety of ways. I don't think it's just a Silicon Valley phenomenon. I think this is proliferated in Canada. Listen, like some companies are public. Like go on Yahoo Finance and literally hit the financials tab.
No. Go to betakit.com.
Go to betakit.com.
The markets tag. See all our markets reporting last week about a number of companies that posted positive earnings, generated net new revenue, and absolutely took a bath in the market. We did a variety of coverage and roundups. We just covered Lightspeed today about how they're like trying to get to a path to positivity after their CEO of a decade and a half was removed because their share price dropped like 80% in the last the 52-week high to current trading for every company in Canadian tech is very, very low. And I believe, credit again, Sean Silcoff, you've been tracking this, tweeted just yesterday that Magnet Forensics, which was the last company of this like last 2-year boom to still be trading above its listing price when it IPO'd, just failed to meet that marker yesterday. So it's all over the place.
You know what's crazy about these IP? It's just such a crazy market. Like you can fairly assume that if a company goes public or were to go public, hypothetically, it would get slashed probably 50 to 80% over its last private market valuation. But there are a bunch of companies that are trading sub their Series C's, sub their Series D's, right? And what's crazy about that is it's actually the investors that are getting particularly burned on in those cases, because remember, right? Investors are buying pref shares in companies. And is it worth talking about pref?
No, we had Damien on 2 weeks ago to explain all of this. So our listeners who listened to that episode with Damien Steele will know that it's not the investors who are getting screwed. It's the employees, because they purchased their shares at a particular price that has dipped spectacularly.
Yeah, but hold on. But here's the kicker. Here's what no one's really talking about, is that when the company goes public, everyone gets equalized, economically at least, right? Like you can have different voting story, whatever the case may be. But when the company goes public, everyone holds the same types of shares. So why is that important if you're an entrepreneur versus if you're an investor? Well, let's just take a basic fact pattern. Let's say, Doug, you have a company called whatever,
BetaKit Incorporated.
BetaKit Incorporated. You create, like a software product for, tech journalism.
Dank
right?
memes.
It's some
yeah.
recurring revenue business.
Yeah.
And I have a venture fund and I invest in your Series C, D, and E. And in each respective round, one you're worth $1 billion, one you're worth $2 billion, one you're worth $3 billion. And in each round, I invest $20 million. So far, so good. So I have a cost base of $60 million in your company. If you don't go public, and if you stay private, and if you get acquired, or if you liquidate in private markets, I can elect to either, and let's say I own 10% of your business, right? And let's say on paper you're worth $3 billion and my cost base is 60 million. I can choose to get my 60 million bucks out, or I can choose to take 10% of my ownership on kind of the top line of the business. If you exit for 3 billion, I'll take 300 million bucks. If you exit for 100 million, right, I'll take my 60 million, right? When you go public, we're all the same. I just own 10% of the business, right? I don't have my 60 million preference anymore. When you inevitably get written down to 300 million bucks or to 200 million bucks or to 150 million bucks, I, as the investor, am getting absolutely shipwrecked. And you, as the entrepreneur, are actually doing okay.
Okay. Two things here. First, Damien totally talked about this before. So it makes me sad to hear that you don't listen to our podcast, because
I listened to that from start to finish.
He said very nice things about you on that podcast. Second, you keep turning this to the poor venture capitalist investors rather than the founders. And I believe the question is,
come on.
So I want to take this to the companies, because we talked about what happened with the bubble bursting. But the next question here, and Katie, I'll jump in because I want to reference the tweet related to this. We had a follow-up question being, what do startups think they'll need to do to weather the current economic climate? So I want you to speak to the startups and the founders right now, because we know that Y Combinator just released something to their founders. It's a 10-point plan, basically saying, here's why you might be fucked. Here's are the things that you need to do to ensure you're not fucked. And if you just try to do some of these things, you'll be much better off than companies who aren't thinking about this until 18 months from now, who then will wake up and realize that they're fucked. We'll link to this in the show notes. But I want you, Tony Dagger, to stop banging your chest and beating your breast for those poor investors with their carry and their fees, and start talking to startups about what they should be thinking about right now. Because I've been at lunch with a few VCs hearing about their founders are trying to decide whether their leadership team are taking pay cuts or layoffs. I'm hearing that angel investors are not sending the checks that they've committed to. And we are hearing about very, very large institutional VC funds in Canada who have the money pulling out of deals. Talk to if you want to name names there, I'll be happy to let you go. But
so first off, I take umbrage. I take great umbrage. Yeah. Listen, for entrepreneurs and founders, it's you either focus on the fund. Like, I hate to say it, like, we're going into a market that's focused on fundamentals, that's focused on cash flow, that's focused on, are you building a sustainable long-term business? And you need to be able to borrow from Rob's lexicon, you need to signal that you're doing that. And the way you signal that is you either grow faster, which is really hard to do, you improve your unit economics, which is also incredibly hard to do if you're already entrenched in a poor business model, or you cut cost, right? Like, you cut cost, you extend your runway, and you hope that you come out of this thing on the other side and you're able to fundraise in an environment that's a little bit more amenable. There's no secret sauce to this. And in many ways, I go back, like, the market screwed a lot of companies, like, especially if you're like a first-time founder and you've been just raising money hand over fist.
Since your university accelerator program that you took.
You might just think the good times never end. And honestly, like, this is where I think bad boards of directors are to blame in many cases, and where a lot of investors did some really bad stuff, where they validated bad business models. They were hoping to invest on a basically momentum strategy, right? We'll pass on the hot potato to the next guy. And eventually we'll get into public markets, and the retail suckers will pay for it. I'm being harsh, but that's a legitimate strategy that people adopted. Like, let's just keep pouring fuel on the fire of this thing that's kind of rotten on the inside. So I think that's what founders do. I think you have a certain war chest if you've raised a big amount of money, if you've raised a lot of money, and you stretch it out. And if you can, you improve your unit economics. You focus on acquiring high value customers at a low cost, and you're a wartime CEO now. It's a weird time to be alive. But I honestly, the thing about this is I emphasize, man, like, a lot of companies they're going to be fine. Like, there are just amazing companies. Like, and I'll name them if you push me, but they're really good businesses, and they may take a valuation cut, maybe, they're going to be totally fine. Like these things are growing like crazy. They're high margin, high product differentiation, amazing management teams, and they're like across the ecosystem from coast to coast. I can name companies like this in every major city in the country. This is macro turbulence, but fundamentally there are a lot of great businesses that are going to be completely fine. And if you're an employee at those businesses, what I do think is worth doing if you're an employee is understand, how your stock options are priced, whether you agree with that valuation, understand how your how much money your company raised, what does the pref stack look like, is it growing? Like make that have that certain level of introspection as an employee and just figure out if you're in the right place. But which I realize is actually not that helpful. But
I got some help there because if you realize you're not in the right place, I've got a message for you. Do you want to work where your imagination makes an impact? Join Tech at RBC, a fast-paced team of innovators working to create positive change for their clients and communities. At RBC, you'll build a meaningful career while working on high-impact projects with some of the top tech and business experts in the country. RBC is hiring for a range of tech positions, from developers to data scientists to cybersecurity professionals and more, possibly podcast guests. Check out the latest roles at jobs.rbc.com/tech.
Did we sponsor this podcast?
Yeah, this is where we disclose that for the second time that we've had you on. Okay, so
what the fuck, dude? That's so unlucky. It's like people will think that.
I know.
Why is he here?
So open, and this is an AMA. This is where this stuff happens. So, as part of the church and state separation, our podcast production team, which includes me, pays no attention to who's sponsoring the podcast any week. Like the anchor man, I just get the copy. They put it in front of me and I read it. This happens to be the second time that Anthony is on the podcast that just happens to be sponsored by RBC, who has been a recurring partner throughout the year. There is no coordination on this part because, by God, believe me, we would have done something like we would have done a song and dance number or something.
Very conspiratorial. He wrote that huge essay so that you could it's a long game. It's a long game.
This is how inbound content marketing works. No, like literally, Tony had no idea. I had no idea until I got the ad read before we were recording. What can I say? When you pull the emergency podcast shoot, sometimes it happens in a week where RBC is like, this is going to be a really good episode for us. We got people like Tony with us. If you want to come work with Tony Dagger, jobs.rbc.com/tech.
You're such an asshole.
I got to do the read, man. I got to do the read. Okay, Katie, get us back on track. Please save us from conflict of interest.
Okay, so it was a riveting and very depressing first half of this podcast episode. So hopefully I'm getting into a bit of optimism here, and it looks like there is some good news. So it looks like the #FreeBoswell campaign might be working. So how much credit does Vas Bednar get for this?
Rob, I'm too close to this. I need you to set the context for our listeners and answer this question.
Oh, gosh. Regular listeners of this show. Actually, Vas has been on. She was on actually quite recently. A friend of the pod. And she's kind of written in every publication, every major Canadian publication. Her focus has been competition and the lack thereof in Canada, and continually pointing out stuff that we do know about, like, say, telcos, and stuff that might not be so clear and might be a little more under the covers. We've been talking about competition commissioner. Is that his role?
I believe he is the commissioner of competition at the Competition Bureau of Canada.
There you go.
Matthew Boswell of Free Boswell hashtag and T-shirt fame.
Exactly. And we've even had Senator Deacon on talking about open banking and sort of threading this into this larger conversation we've been having about competition. And it looks like that Vas's lobbying, maybe almost single-handedly, has paid off. There's talk about, I think the latest news was that the Rogers Shaw merger was thought to be a bad idea. Commissioner Boswell said didn't meet the criteria to actually stop it. So it's still going ahead. So everyone's holding their nose, but the merger's happening. So basically, there's a lot of focus around in this budget and this thinking around competition and sort of renewed vigor around it.
But are you saying it's because of Vass's op-eds, Vass's podcast appearances?
No, it's podcast appearances.
Okay.
It's pretty clear. I mean, we've had Minister Baines on.
Is it the t-shirt, though? The Free Boswell? Like what? Matt Boswell woke up this year and chose competition. Whether or not blocking the merger actually happens, this is dramatically new. And we even, just something that dropped yesterday, BetaK didn't report on it, but the Competition Bureau has successfully lobbied Churro, which is a vehicle marketplace, to change their policies because they were preventing certain vehicles from being listed on any other marketplace beyond them. So they've changed their terms of services. I think this is pretty cool. And I think maybe soon we're going to be able to ask Mr. Boswell, if not in person, podcast mic to podcast mic, if he thinks it was Vass, or if he thinks it was Vass on our podcast, or if he thinks it's like a holy trinity of Vass, the podcast, and then some really well-designed t-shirts that might have been delivered across Ottawa that have been making the rounds. But I would say it's a combination. You know, we're a big tent party here at the BetaK podcast in the Free Boswell campaign. I would say everyone's chipping in. And that's what we truly need to not be, as a country, 3 telecoms in a trench coat.
Much better put.
Okay, next question.
Possibly last question?
Next and last question. What happened to the buzz and decline in wearable tech? Is it making a comeback with the popularity in the Oura Ring that has heavy celebrity endorsements?
That's an interesting question.
Let me just say, my Fitbit is at the bottom of my drawer somewhere. I have not touched it in at least like 5 years. So I don't know where I stand on wearable tech, but it ain't anything that's happening in my life these days.
So I'm gonna. This is a bit of a blast from the past for me. So I don't know if you guys know this, but I was the founder of a wearables company for a while until we pivoted away from wearables. Yeah, so I'll give you kind of the history there. So I will say, though, I'm wearing an Oura Ring in real time, but wearables are weird. I think if I were to summarize, the issue with wearables is really just customer retention. Like ultimately, like it's very difficult to get consumers to remain loyal to wearable. It's not, for whatever reason, it's not engaging enough. Like different companies have tried different things with rewards and gamification and all that kind of stuff. It's just people don't fundamentally care enough. I'll give you a bit of a history on kind of what we did and our pivot away from wearables and why we did what we did. But essentially we had been, this is way back this must have been like the mid 2010s. We had been building a
almost
patch.
10 years ago, 1,000 years in technology time.
And so what we had been doing was we've been trying to build a patch that you wore around. It was kind of like inconspicuous. That was kind of our thesis at the time, right? Like you don't need to see the wearable. It's going to be anyway. Net. What we ended up doing was we built algorithms that could capture biometrics mechanically through an accelerometer, which is on every iPhone and every Android phone already. And so we had this epiphany moment where we just said it's so goddamn difficult to manufacture hardware. If we're going to bring this back to VC, no one's going to fund hardware in this country ever. Like it is a wasteland. And then like consumer hardware, completely forget about it. And so we made this decision to move the algorithm to the phone. And that's kind of how we built the business as a kind of pure software business. And the rest is kind of history, which I won't get into. From my experience, it's just customers won't keep using them. But I'm still using the Oura Ring. I think it's awesome. It's comfortable. It's fashionable.
Okay, I'll add that I've actually been on the hunt for a tech wearable for a couple years now, and I was actually saving up for a Garmin smartwatch. But the reason why I liked it so much is because it looked like a regular analog watch. It didn't look digital. It didn't have any sort of technical stuff. And I liked it because I could kind of use it and wear it as like a timeless piece that nobody would suspect is this little techie thing. So yeah, but there's nothing else like it. They just discontinued making that design, and now I can't find anything else like it.
Yeah, like I think I mean what you're basically saying is there are hype cycles and things go in hype cycles. And
can you believe it? Have you guys tried Oura Rings though?
Not yet. I have the watch. I'm really happy with the Apple Watch.
Really, the
personally,
only
but
wearable I've ever used is the Apple Watch, and I stopped using it.
I had the OG Fitbit that was like you wear on your belt.
yeah,
But the Aura,
I got a
like
couple
the
of
Aura
Fitbits
and
in
the
the box
thing
as
does
well.
the same basic thing. The Apple Watch. I'm pointing to my Apple Watch. This is an audio show, everybody. The Aura and the Apple Watch effectively do the same thing, just the form factor is different. No,
I guess I can't wear an Apple Watch. I don't like watches on
Being
my wrist.
cool.
Like the Aura Watch.
Does
I don't like
does
being
the face
cool.
of the Oura Ring explode off your wrist after you've been using the device for 5 years, and then Apple comes and says, "Oh, this is a vintage device. We don't support watches that have existed for 5 years." No, I think Andy, to your point, like you were talking about, like the issue is retention. The issue is utility. There are very few wearables that justify their expense and their limited lifespan. And I know you think that VCs did not want to invest in this stuff, but in Canada there were significant investments. Where you want to talk about Recon Instruments and their wearable, if you want to talk about Thalmic and their crazy Iron Man wrist thing, or their pivot to Vision Tech when they rebranded to North, getting money from Intel, Amazon's Alexa fund, basically ending up not being able to commercialize that, sell that IP. Rob, I think if not the very first issue of the BetaKit podcast back when it was called CanCon, or certainly by the episode 5, we were talking about the wearable hype cycle. We used to have a wonderful wearable editor who at like a certain point we had to have a conversation and just say, like, there's actually no new interesting wearables news to cover anymore. But it is interesting that you're rocking that ring on this podcast. Is there any interest in this room at an Apple VR AR headset? Apparently The Verge is reporting today that they've at least shown the prototype to the company's board of directors. Does that get I'm out on Apple wearable products after going through 2 completely broken AirPods and a Apple Watch that literally exploded off my wrist. But does anyone want to put some Apple on their face?
I'm good.
I would, but I go back to the point that you're making, both of you, well, actually all of you are making, utility. What's the utility of the thing? I think the form factor has to make sense, and wearing Apple's version of an Oculus is not what I'm looking for in my life. What I'm looking for is the glasses that I wear every day happen to be smart. And I don't necessarily need cameras for taking photos of people, and that's still kind of around. Snap's still doing some stuff. Ray-Ban and like that still does exist in a very niche kind of way. But if I can get information, I mean, Google had their I/O conference where they about a month ago showed the like real-time translation stuff going on. That's utility. That's kind of transparent to the way that you actually live your life. So if you want adoption, you need to look like a normal human being. And the use case, I mean, don't forget, when Apple started building the watch, they're like, it's all the things. It's basically an iPhone on your wrist. And then they realized, people really want was exercise. So if you look at all of their ads and all it's basically a Fitbit with notification, right? It's basically a sexy Fitbit. So that's what people want out of a wristwatch or wrist-worn device. It's really hard to hold the thing up for a really long time and do anything. Maybe I'm just really wimpy. So I think that I do want an Apple version of whatever a wearable thing is when it blends into the universe that I happen to live in and isn't like ridiculous, and it provides me the right kind of information the right way. And I think North was getting there. I mean, it didn't, but the idea of like directional information or overlays of like Yelp reviews, I think that's what Google showed off. That kind of stuff is actually kind of useful. I don't want to pull out my phone. I mean, one of the problems in our society at the moment is we keep looking at our phones and we're not actually making human contact. So if there's a way to have wearables where it allows me to at least approximate something like human interaction, it's better than the BlackBerry Prayer, as it used to be called.
I remember this moment in you talking about utility. You guys know Ken Nickerson at
I do.
Homer's Venture?
Yeah.
So
He's
Ken,
co-founder of Kobo.
Ken's a dear friend. He was my first angel investor. Actually, he was on my board for a long time. So we hung out a ton. I remember this conversation a few years ago with my co-founder at the time, Alex and Ken, and we were sitting for lunch. And you know Ken, right? Like he's the first to get anything. Like he is.
Yeah. He was running a Raspberry Pi cluster like 4 years ago. I'm like, why are you doing that?
Rob is our Ken.
Yes,
it's insane. He's like, yeah,
Me and Ken are
Ken's the bellwether. Like Ken, like will get his hands on the first anything, and he got these smart glasses. I forget what they were. They must have been like Google, or maybe they were the North. Yeah, I forget exactly, but it was these smart glasses, and we sat down for lunch, and he's like showing them to us. And I'm like, Ken, like, but like like, what's the use case? And he goes, he like thinks about it. He's like, well, I can see the weather on them. And I go, okay, great. And then he's like, but imagine like you're sitting talking to someone and then, you know, like their LinkedIn profile like comes up like in the glass, like right next to them. I remember like we had this moment where we just like looked at each other and I was just like, this is not going to work. Like no one wants that. I was like, dude, I don't want to like see someone's LinkedIn
I don't want to know who people. Yeah, I do. I don't remember. I don't have to remember anything about it. I can look like
conversation. Yeah. So I totally agree. And I think the same thing's true for a bunch of stuff like, you know, AR, VR, and a bunch of technology. It's just, do people actually want it? Is it useful?
I love that. With all the drama off the top of the dramatic changes, like the one constant in our lives is that this podcast group has remained thoroughly unimpressed with wearable technology for the entire 6-year run of this podcast.
We just need Tom Emmerich on. Let's have a chat.
Yes, we miss you, Tom. We loved you. I just think there's a lot of people who reference the metaverse and maybe were bought a copy of the book Snow Crash when they started at Oculus or whatever. I just say, read the book and see if that's actually something you want to be building towards or moving society away from. See, Tony, that's how we get the really darkest time on social.
Like, it was so good. We were so happy.
That's why I wonder why I'm invited to this podcast sometimes, because I am just the eternal optimist for the most part, and I just don't know how I mesh with you guys, but somehow we make it work.
I'm optimistic too. I'm optimistic too. Yeah, I think it comes off as, I remember the last podcast we did, I was like really trying to be optimistic and I was like, you know, always silver lining everything. And then I see the title come out the next day or whatever, and Douglas is like, Tony, like, yeah, he's like, Tony thinks like the whole thing is like Jenga blocks. It's all coming down. I was, oh shit.
Jenga's a game. It's a fun game, guys. What do you got against a fun game? I wonder what the title of this episode will be.
Well, it's funny because like I've been a lot of conversations about the Damien Steele podcast, and I'm like, did you listen to it? And the people I've been talking to are like, no. And like, I'm like, but this is what we talked about. And then, but if you look at the title, it belies the content sometimes, you know? So it's like, why you shouldn't click on headlines. I'm like, no, this is a thorough analysis of the current state of the union. You should totally listen to this show. When you listen to it, you're like, yeah, but it is a clickable headline.
Sometimes I get too meta for my own good and benefit. But we have pitched, and I think we should reinforce it now, a Steele versus Dagger AMA event where we'll have both of you on. At that point, no one has to be optimistic.
Problem is we'll agree with each other on most stuff, I think, if you drill down to it.
No, I think Damien actually cares about founders. He cares about founders more than he cares
about
business.
Don't do that. Don't do that. I love founders.
The BetaKit podcast is produced by BetaKit Incorporated. It's edited by Katie Lohr, and its hosts are Rob Kennedy and me, Douglas Saltis. To learn more about how you can support this podcast, head to patreon.com/BetaKit.